All right. Good morning, everyone. The time is now 10 o'clock. Thank you so much for joining us this almost summery morning here. It's a beautiful morning, and we have a really interesting presentation for you today. Of course, my name is Christina Gallagher. I'm the marketing director here at Homestead Village, and you are part of our webinar series that always intends to bring helpful information that you can apply to your current life and maybe a future move here to Homestead. So of course, today we have financial planning for a fruitful future. So we have lovely presenters here from Fulton Bank who will introduce themselves. So without further ado, I will turn it over to our lovely presenters.
Good morning. Thank you, Christina. We really appreciate the opportunity to be here with friends of Homestead Village. As you see on the screen, you'll have two presenters today, and I am Jeff Bankert. I'm a certified financial planner, so I'll be talking about the financial planning side of the presentation, and then my colleague Matt Brennan will be giving you an update on where things stand from an economic perspective and what that means for investment portfolios. So I hope you look forward to hearing the presentation as much as we look forward to delivering it. Matt, thank you. And that's me. So there is some gray hair here. I've been around Fulton for 33 years, as you saw on the prior slide, and been a certified financial planner for 2 decades. So my planning today will be broad in nature. And this slide here, from a disclosure standpoint, says that we will be using rules of thumb and words like typically. So we are speaking in general terms. We do always advise that you consult your advisors based on your unique circumstances. We at Fulton do not provide legal or tax advice, so the attorney or the CPA certainly can fill in all gaps knowing your situation. However, we do repeat what we see from clients quite frequently, so that's helpful. We plan based on laws as currently written, and laws can change at any given time. So just last Friday, we got the Biden budget. All politics aside, it appears that there will be some increased spending to help programming for the United States, and that comes with increased taxation the way it appears. So nothing is approved yet. We're going to talk about present tax law, but we may throw in some references to what President Biden has proposed at this point. And then thanks finally for recognizing that we do have a broad audience. So what is new to some and enlightening might be old hat for someone else, but we'll speak in general terms today. Matt? Okay, so as we think about retirement, preparing for retirement or when in retirement, we do think several things are really important. So we think understanding your cash flow sources, and we'll focus a little more on Social Security in a moment, but your pensions, your IRAs, rollover IRAs, I would probably throw annuities into this stream just so that we can understand what kind of income cash flows, any rental income from properties that you have, and so forth and so on. And then I would slide down to understanding your assets and liabilities. So from a liquidity perspective, again, I mentioned I'm a CFP, the Certified Financial Planner Board says having 3 to 6 months worth of expenses in liquid funds makes a lot of sense. Understanding expected returns is really important, and then the volatility or standard deviation that goes along with those returns. And I think if I don't cover it adequately here, Matt can talk at much greater levels about that. And then taxation. So for any of our viewers that are in the $1 million and up income category, that doesn't catch a lot of us, but it catches some of us probably, and it catches certainly some of Fulton's clients. We today pay 20% in capital gains tax, but we're looking at a proposal of 39.6 plus the Medicare overage. So we could be staring at a 43% capital gain rate going forward if you make $1 million or more, and if that law is enacted. So Those are really important considerations as we go. We believe that everybody should have a budget, and that doesn't stop in your retirement years. Rules of thumb are you'll need 70 to 80% of the income that you made while you were working in your retirement years. Of course, things like packing lunches and sport coats and suits, those go away. You don't have to pay for some of your travel expenses back and forth to work, but other things kick in. So I presume most of us will want to enjoy our retirement, so entertainment expenses and healthcare certainly come into play. And then finally, as you prepare for retirement, I believe it's wise to consult a financial advisor. So financial advisors are certainly trained and have tools that can help you to focus on what it is that you'll need to fund a 20, 30, 35-year retirement period. So really important to understand that first bullet point there is the impact of inflation. So $1 in cost in 2021, we want to make sure that your purchasing power is preserved throughout your retirement. So you can see that that dollar in 10 years costs you $1.28. And in 20 years, it's $1.63. So if you said, I want $100,000 a year in retirement, and you pegged it at $100,000 flat, you're going to have less purchasing power 20 years from now than you do today. So one of the tools we have at our disposal at Fulton, and I would suggest that most financial advisors would, certainly throws in the impact of inflation, and it increases the amount of dollars you need to take from your income sources above to continue your purchasing power plan. We believe in Monte Carlo simulation as well. So our financial planning software essentially will say, you know what, if you adopt I'm making this up, but a balanced growth approach to your investments in your retirement years, you'd have 50% stocks, 50% bonds, and cash. That's going to yield, and again, I'm close, but that historically might yield a 5.5 to 6% return, that mix. But that doesn't come uniformly or in linear fashion. So what Monte Carlo simulation does is recognize that some years are going to be better and some years are going to be worse. And what if all the worse years come at the beginning of your retirement period when you've got the most in your bucket? What does that do? So Monte Carlo simulation simply looks at the what ifs involved in your retirement period. So really important to not run a static financial plan, but to run something that's a little more dynamic. And then planning for your estate becomes really important. And most people want to make sure that they've got adequate resources to last their lifetime and to provide for the retirement that they want. But one does need to think about how we transition assets to the next generation or to charity, depending on our interests. Matt? Okay, Social Security, we said we'd dive a little deeper, and I'm not going to go too deep because at Fulton, we always recommend that you do visit your local Social Security office to understand your options and optimize your selections. But if you haven't retired yet, full retirement age for most coming out of the workforce today is pushing 67. You know that you can take early benefits at 62, but there is a 30% discount. Part-time work, if you are taking early benefits, you do have to watch how much you make. And that number, that 17,640, forgive me, I tried to update that, and it's now 18,930 in 2021. So you can make nearly $19,000 before your benefits get impacted. But do know that there is a cap to how much you can make from a part-time work perspective. And we ran some just very general scenarios and said, gosh, when am I better off taking my Social Security benefits at age 62 versus waiting until full retirement age, FRA, you'll see that referenced as here, full retirement age of 67, or even deferring and delaying benefits until age 70. So that chart, ignoring, you see the asterisk at the bottom, considering a constant monthly payment without cost of living adjustments, that break-even period, if you know when your life expectancy comes to a close, if it's less than age 77, you're probably better off taking your benefits early. If you can wait till full retirement age, there is no discount, of course. And then if you can wait even further to age 70, you can get an 8% increase in benefits for each year beyond your FRA. So many of my clients are fluent and have the capacity to wait, so they will wait. That 8% or 24% increase in benefits makes a lot of sense to them. I do have a bullet point here about higher earner delay, and we see that quite commonly, where the lower earner throughout their working life will take a benefit at full retirement age, and then the higher earner will delay, and that works out nicely. If the higher earner ends up passing away, then the surviving spouse can take that person's benefit as opposed to their benefit, assuming it's higher, especially with the 70 deferred benefit, age 70 deferred benefit. So another bullet point there, life expectancy greater than 82. Generally, we would say wait until you're 70 because, gosh, years 82, 83, 84, 85, and so forth and so on, you're going to make more money and overall will make more money. Matt, thank you. So IRA management, really important topic here. Most of our clients, back in the day, there were pension plans for most every employer. Today, we have 401k type plans instead, and that means that we're all responsible for our own balances and our own rollovers. So at retirement, we see a lot of rollovers into Fulton managed IRAs, or any advisor out there can certainly handle a rollover IRA for you. Our point here is trustee to trustee rollovers make the most sense. From our perspective, there's not a lot of risk in going trustee to trustee. There's no withholding of taxes, and there's no taxation at the end. There's no proving lack of taxation at the end. Whereas if you take a check from your employer's 401k and reinvest it within 60 days, which is allowable, typically they will withhold 20% of that rollover distribution, and they will you will have to prove to the IRS that you reinvested it within 60 days. So we recommend a trustee to trustee rollover. The traditional IRA or traditional 401k is tax deferred. So you are not paying immediately upon retirement, in most cases, paying taxes. So your income has now dropped because you've stopped working. And if you can wait until age 72, which is, I'm sure most on the call are familiar, that used to be 70 and a half. You had to start taking required minimum distributions. The Secure Act pushed it to age 72. So we have a whopping 18-month deferral, but that becomes important. So you don't have to start taking those tax deferred distributions and paying taxes on them until age 72. We are seeing more and more retirees come out with Roth contributions to their 401k. So it's conceivable that you'll have both traditional and Roth contributions inside of your 401k. When you roll out, you will have to roll into two separate IRAs. So you'll still have your traditional, and then you'll also have a Roth. Of course, the Roth you've already paid the taxes on. And in fact, that's down at the bottom of the page. So in fact, let me jump down there right now. So those Roth contributions, no RMDs under present law, and we see that continuing, or at least being grandfathered. And so if you've made Roth 401k contributions, you certainly will not have to pay tax on those contributions or the growth from those contributions again. This bullet point actually talks about Roth conversions. So we have a lot of clients in lower tax bracket years considering taking their traditional IRA, paying the tax, let's say at age 68, paying the tax, and then making that a Roth, holding Roth characteristics the rest of its life. So if you're 68 when you do that and you make it to 88, you will have no more taxes for the 20 years, and it decreases the RMD from the traditional IRA. So you don't have to take as much, and you won't have to pay as many taxes. So that's a really popular strategy, especially right now, as We expect that tax rates will go up to get rid of deficits and to create more revenue for programming for the U.S. Treasury. So we'll see what happens. Let me jump back up to qualified charitable distributions. So QCDs, we call these in the industry, and they remain at age 70 and a half. So while required minimum distributions went up to 72, QCDs can still be done at age 70 and a half. And you may make dollar for dollar charitable contributions up to $100,000 in RMD. So if your pot of assets and your life expectancy determines that your required minimum distribution would be $110,000, you can give $100,000 directly to charity. It must come directly from your trustee to that charity. You don't just write the check. But you can give the $100,000 away and then only pay tax on the $10,000. So 110 RMD, give away $100,000 to charity, and only the $10,000 gets taxed at the end of the year. So we see our affluent clients using that to fulfill their charitable inclinations and any pledges they may have made to support nonprofits in the area. Instead of just writing a check, they're taking it directly out of their traditional IRA at that point. Okay, asset characterization and allocation. So again, we think that every customer should have a liquid component to their balance sheet. So liquid just means ready cash, and that is how much do you keep in your checking account, how much in your money market, how much in money market mutual funds, or things that can be converted to cash really quickly and efficiently. And I started the presentation by saying the CFP board, the CFP board actually suggests 3 to 6 months of expenses. So if you spend $100,000 a year to cover your living expenses, it would be prudent probably to have $50,000 sitting in these sources. Now, we would be remiss if we didn't note how little return you're getting on all those things right now. In this interest rate environment, as a banker, I will tell you that my borrowing customers love me because it's very inexpensive to borrow money right now. But my depositing customers are not nearly as happy because you're seeing yields of 5 basis points, 0.05%. You're seeing yields of 0.20% on your CDs and so forth. And it's on a fixed income, and you're relying on that interest income coming in from liquid funds. There's just not a whole lot to get excited about there at this point. In fact, we had a question ahead of time today. What do I do to seek yield? And again, Matt can probably make some more in-depth comments on this, but we see our clients today turning to some ultra short-term bond funds. They are not without principal risk. So your net asset value in an ultra short bond fund can go down a penny, it can go up a penny. So you do have some principal at risk. However, yields, we work with some particular funds that might be in the 75 basis point, 80 basis point range for ultra short bond funds at this point. So, you have to watch if you're relying on an advisor or a broker to buy those for you. There's generally a fee involved. So if you're making 0.75, but you're paying 0.50, you're right back down to where bank CDs are probably sitting today. If you are in a position and feel comfortable buying something on your own, doing the research and buying something on your own, then an ultra short bond fund may make some sense for you for yield. And we do see some clients exploring annuities. Some annuities are useful in that instance, and they have some guarantees to them. So, again, talk to an advisor that you trust and a company that you trust to understand those annuity options. And even some charities and maybe Homestead Village. I'm sorry, I don't know the answer to that, but charitable gift annuities. If that money, if you're in a position to give money away, and you're thinking about doing, you're going to do that at your passing, some clients have accelerated that gift and then received an income stream back from something called a charitable gift annuity during their lifetime. So again, good to understand that you have the capacity to do those things before you actually get into those. And we've been telling clients, again, Matt may comment in the end, but we've been telling clients that the equity market at this point might be the only place where you can get a combination of appreciation and income that offsets purchasing power risk or inflation. So if inflation is going to be 2% historically or 2.25% historically, we hear conversations about inflation going up at this point based on what's happening in the economy. Again, Matt will speak to that, but if that happens, the only place you can beat inflation from a yield perspective is to add some stocks to your portfolio. So that is the second bullet point here. Conventional securities, assessing your mix is always important. So how many stocks, how many bonds, what kind of mutual funds and ETFs do I use for diversification or to fulfill certain purposes within the investment portfolio? And, as we generally see clients as they age, maybe, instead of 80-20, which is 80% stocks and 20% bonds during their accumulation years, they may slide down from a risk or volatility perspective to a more balanced approach. So 50-50 might make sense for you, but that's an individual decision, and everybody looks at it. Everybody looks at it differently. I do note here, preserving that purchasing power. The Social Security Administration says that 25% of all 65-year-olds will see age 90. So preserve that. That's a 35-year retirement period for most of us, and preserving purchasing power certainly makes some sense. Many of our clients, and I suspect many of you on the call, may have owned real estate. Income producing real estate, may have been a partner in a business, a small business or a large business, and you may hold some investments that you've made in companies, private equity, direct investment. Generally, those things are all held for income production characteristics, and they are somewhat illiquid. It takes some time to liquidate a business or liquidate real estate. So, though those things can be pledged as collateral for loans, we would ask our retirees or near retirees, what is your exit strategy and how do you convert those things into income production? Certainly, if you've got a rental property that's throwing off, it's paid for and you don't have a lot of expenses and it's throwing off great income to you, then that just becomes another income source combined with your stocks, bonds, mutual funds, and so forth. And that's A-OK. Stepped up basis is the last bullet point we have on that particular slide. I'm sorry. Yeah, and stepped up basis is being talked about quite a bit right now, and there are some proposals to make it go away. But today, the rule is you still get stepped up basis at passing. So it's really important from a estate planning perspective to figure out what assets you'd like to give to your next generation, or what you're going to give to charity, or what you're going to liquidate and count on spending during your lifetime. So, as an example, if you bought that rental property that I just talked about for $50,000 years ago, and you fully depreciated it from your through your tax return, and its basis is zero, and you pass, and it's now worth $300,000 in this new real estate market, then whomever inherits that is going to get a stepped up basis to market value at the date of your passing. So that eliminates a $300,000 capital gain times 20% in today's world. So you don't have to write a $60,000 check. So stepped up basis is really important, determining which asset will I hold on to and hope can pass to the next generation without additional taxation. Matt. So liability management, I said my loan customers love me today because rates are really low, and that remains true. But we generally do see our clients deleverage as they approach retirement or in their early retirement years. So you've paid off your mortgages, you've paid off, in many cases, car loans, Certainly, if you help a child with student loans, that's on them at this point. But a couple of tips we have here. It's not unheard of that somebody will buy a second home in their retirement years or as they approach retirement. And just do remember that only $750,000 in mortgage debt is deductible. That can be first or second home at this point. And, I've got a few clients. I met with one just yesterday who did a property in Stone Harbor. Their investment is well over $750,000, but they talked to me about mortgage financing to lock in low interest rates for the next 15 years. And they decided to only borrow $750,000 to kind of reimburse them for the expenses that they made out of pocket. So $750,000 will be that the interest on the 750 will be fully deductible for them because they have no other mortgage debt. So just know that that's in place. And home equity interest has gone away. We do advise talking to your CPA because it is not product driven, mortgage versus home equity loan. It's actually purpose driven in the IRS language, but you and your CPA need to be comfortable with what you can deduct. As a for instance, I only have a home equity loan on my house at this point, but because it was either purchase money or it was refinancing of purchase money, or it was construction money or refinancing of construction money. Those three causes, those three purposes can still allow a home equity loan to be deductible. So check with your CPA on that. And then one thing I wanted to make clear on this call is as I watch my clients age, we do try to put a home equity line of credit in place before one needs it. So underwriting criteria, it takes probably 30 days to put a loan in place today. And I can tell you at Fulton Bank and probably at some other banks, if your home is presently for sale because you need to sell it or want to sell it, maybe to pay an entry fee to Homestead Village or your retirement community of choice, it is better to have that line in place against the equity in your property now and simply write a check for your entry fee to Homestead Village, as opposed to waiting and trying to sell it. Now, in this market, you probably won't have much trouble selling it, but in some markets, we do see delayed selling timeframes, and it takes longer to get to closing, and therefore you won't have access to that cash. So put a line of credit in place before you need it is one of the recommendations I would have for this audience. Swing loans would be available once you sold your home. You need to pay the entry fee here, and then your home settlement is 60 days down the road. You can get a swing loan from a bank, but typically because of the short-term nature of the loan, the rates are higher and there may be origination fees. So again, at Fulton, we charge 1% to do that loan. So if you're taking $300,000 in equity and swinging it for your entry fee, you might pay a $3,000 fee. So put that line of credit in place before you need it. Okay, healthcare, a big expense in the retirement years. So many of you may already be Medicare experts. You could probably teach me a thing or two, or you may be approaching the Medicare age. So we say talk to a trusted specialist. There's so many things that you need to know about Medicare and what it pays for and what it doesn't. Two of which I think for this audience in particular, in that second bullet point down underneath of Medicare supplement or Medicare, limitations on custodial care only for activities of daily living, and then skilled nursing care is not paid for by Medicare, with the exception of following a qualified hospital stay and a limitation probably of 100 days. There's 100% coverage for the first so many days, and then there might be 80% coverage for the rest of those days, but skilled nursing care must follow a hospital stay, and I think it's three days. So don't count on Medicare to pay for your skilled nursing care at a facility, again, like Homestead or anywhere else. I'm going to skip the early retirement piece and jump to health savings accounts. But I'm sorry, for any of you that are still working, and if you have a high deductible plan, we believe, and we've been recommending to our clients, that funding an HSA to get ready for your retirement years is really prudent. So triple tax free. You get to make a tax-free contribution while working. It's tax deferred. It grows on a tax deferred basis, and then it's tax free on the way out, as long as you're paying for qualified medical expenses. So triple tax free, there aren't a whole lot of opportunities for that. If you have a family plan and you're over 50, you're putting away essentially $8,000 a year at this point, and it becomes another way that you can get tax deferred savings for your retirement period. Long-term care insurance is the next bold print just under that. And long-term care insurance is tricky. I would guess that for many of you, as a Homestead Village or any continuing care retirement community would do, they're going to qualify you for coming into their community and the continuum of care that you get here. So having a long-term care insurance policy, I would guess, makes you a very attractive candidate to come in. Long-term care insurance, I think in the industry, we've kind of said, if you're on the lower end of the income and asset spectrum, you maybe don't want to go pay for a long-term care insurance policy because you will probably be cared for by Medicaid and the state, but you probably won't have a choice of where you go. You might only have a few choices at your disposal for that care. And then on the very, very high end, so when I have clients with multiples of millions of dollars invested with us, we often say you can self-insure. Excuse me. By self-insuring, we mean, might be, I'm making this up, but let's say it's $140,000 a year for skilled nursing care. If you had to carry that in today's dollars, but remember inflation, so it may be $200,000 per year by the time you need it. If you had to carry that for a period of, say 3, 4, 5 years, it can eat into a retirement savings. It can eat into a bucket of assets pretty quickly. So consider long-term care insurance and see if it's right for you. Talk to your advisor about that. And then community living, aging in place, continuum of care, places like Homestead Village. I think it's really important as you prepare for retirement and in your early retirement years to think through all of these things. So how will I be cared for in my retirement years? And think about your medical needs, your physical needs. So how active can you be? I don't mind sharing with you, my own father is in a 55 plus community, but has a very steep driveway and now finds himself on a walker, and he is uncomfortable going down that driveway. So he has a physical limitation and ends up spending a lot of time in his home and walking around inside his home. But that's a limitation that I'm uncomfortable with as a son. I want him to get out and exercise those muscles. The emotional and social benefits of being in a community living space, I think make a lot of sense. I love to, I was just sitting in the lobby of Homestead Village and heard lots of activities today over the loudspeaker. So those kinds of things where you get to be with friends and be with associates are really valuable. So certainly look at your financial capacity and understand wait lists. So I don't know Homestead's position at this point, but you typically can put your name on a wait list for a small amount of money. And that money generally is applied toward your entry if and when you decide that it's time to come. So, think about getting on that wait list before you quote unquote need it. I think that waiting too long probably becomes of concern for family members and for you, perhaps, if you only get on that list when you need it, and there's a 12 or an 18 or a 24-month waiting period, you may have waited too long. I'm going to give a quick look at my clock because I want to allow Matt adequate time to cover the economy and all that interesting stuff. So I'm going to wrap up relatively quickly here, but excuse me, from a estate planning perspective, I do recommend that all of our clients have a will and a durable power of attorney and a healthcare directive, a living will in place, and then review it on a regular basis, especially with all those tax laws coming. We ask all of our clients to review their beneficiary designations. So inside of, a life insurance policy, an IRA, a 401k, a Rev Trust, just make sure that your money is going where you want it to go. And that's especially important if there has been a passing, a divorce, a death, a second marriage. All those reasons make beneficiary designation review. And don't forget that 401k from 30 years ago that's still sitting at your employer. Go back and take a look at it. Review ownership of assets. So you definitely want to consider, what assets do I want to go into my probate estate, and which assets can pass by contract, as I just mentioned, with beneficiary designations. So payable on death titling of bank accounts and investment accounts becomes pretty popular in your retirement years. And then contemplate creating a trust. And sometimes people say, I'm not sure I need a trust. Well, many people like trusts for two reasons: tax purposes. So we all have a unified credit, an exemption of 11.7 million today. So husband and wife might have to be worth $23 million before it really comes into effect, before estate taxes really come into effect. But look at January 1, 2026, that number comes down to 5.49. So if you owned a business or own a business, if you owned a lot of real estate, if you have material life insurance policies, it's certainly possible that one or both of you could get above 5.49 million or 10 million combined, 11 million combined. So, and if you don't need it for tax purposes, that's okay. You may still want to consider a trust for control purposes so that you make sure your spouse is cared for the rest of his or her life after you're gone. And then maybe children and grandchildren become direct beneficiaries of that trust thereafter. So trustee, like a Fulton Bank or most banks have trust departments, is called a corporate trustee, and we act as a fiduciary. So we can serve as sole trustee, where you've hired us for that reason. We can serve as co-trustee. So maybe you have a child that you want to be involved in the decision making, but you want Fulton's expertise alongside that child. That's called co-trustee. Or a successor trustee. So maybe I've seen my clients name their accountant, but their accountant passes before them. So in their documents, it will say blah, blah, blah CPA or Fulton Bank successor trustee. So think about those things. And then finally, my last slide, a family packet approach. So we believe in leaving information for your family and contemplating, where are all your documents? Who are all your advisors? What is their contact information and accounts? And this second bullet point becomes really important. Many of us have e-statements only. So if you have e-statements only, there's not a piece of paper that's coming in the mail to remind somebody, oh yeah, they had a small account over at Merrill Lynch. So we don't want to forget about those things and have them go by the wayside until the state confiscates them years from now. So online account access information becomes really important. Matt and I, my colleague Matt and I just sat through a presentation at Fulton talking about digital assets. So cryptocurrency certainly comes into play. If you are a sole owner of cryptocurrency, and you better give the password to somebody that can access that stuff. But social media, music, if you're buying music on iTunes, your pictures that are all electronic today. We used to have shoe boxes filled with family mementos and pictures, and now we have many of our photographs are electronic. So make sure people know how to get to that stuff and make sure they know that you have that stuff. And I'll let you read down through the rest of the family packet approach, but I want to allow Matt some adequate time to get to his slides. So Matt, may I turn the presentation over to you? I think you're next.
Absolutely. Thanks, Jeff. Great job, giving a great summation of some things to be considering as you enter into and work through retirement. Just for time's sake, I'm going to give a relatively abbreviated version. We want to leave a little bit of time for questions at the end, but I'll dive right in for the sake of time. So our viewpoint in 2021 is that we're going to have an incredibly strong economic growth environment. It's likely going to be the strongest economic growth environment that I've experienced in my career and likely ever will. And there are several reasons for that. So the key economic drivers this year are going to be reopening the economy. So looking back to April of last year, the economy was operating at about 38% capacity. Now we're back to close to 90% capacity. As we continue to get closer and closer to 100, that's going to continue to be a driver of economic growth. There's also an unprecedented amount of fiscal policy support, not just in the United States, but around the globe, that we think is also going to contribute to this strong economic growth environment, at least in the near term over the next 12 to 18 months. And finally, we've got a robust, what I've been calling savings war chest that savers have built up, not just in the United States, but in China and in Europe as well. So in the United States, we estimate that there's about $2.3 trillion in forced savings. The savings rate went from a range of about 4 to 5% all the way up to 36% during the depths of the crisis, ended up coming in around 27% for that entire time period. And that has built up this $2.3 trillion savings war chest that we think is going to be unleashed in a torrent of spending as the economy continues to open. So given that view of strong economic growth, we think that the stock market in particular is a relatively attractive place to be, particularly when you compare that to a bond that's paying historically low interest rates at the current moment. So it's not just us that has this view. Across Wall Street, across the experts, they're all calling for this incredibly strong economic growth environment in 2021. So to put it in perspective, we've been growing somewhere around 2 to 3% really for the last decade. We're going to see double. There are some estimates that maybe even we will see triple that rate of growth in 2021. And it's still going to be very robust in the 4 to 5% range in 2022. And one of the most important things to understand about this recovery is how extraordinarily fast it's been. The recession was the shortest in history. So it technically only lasted for 2 months. The next shortest was clocking in at 7 months. So about 2.5 times longer than the COVID recession. And we've recovered back to the pre-COVID GDP baseline in record time and are expected to grow past the pre-COVID baseline or trend line in the third quarter of this year. That will be the fastest recovery that we've experienced in history. And a lot of that has to do with some of the things that I discussed, that unprecedented amount of policy support. So policymakers underwrote the losses that people experienced during the COVID crisis when they told people that they could not go to work, they could not operate their businesses. They, much like you would compensate someone for eminent domain, if the government comes in and says they're going to use your land, they have to compensate you for that. That was really how we viewed the approach to the fiscal policy measures that were put in place. And that's led to this incredibly strong recovery. But that has some risks that come with it as well. And I'll talk about those in a moment. Want to talk about now where we are currently, just talked about where we're coming from, where we are currently, and then where we're expecting to go. So as of the most recent numbers, we take a look at current activity. That gives us an idea or gives us a gauge of what's going on in the immediate environment. Really, we've seen surging activity. So it's up 10% month over month. When you look at the underlying factors, we've got manufacturing and services in particular have really started to rise. Personal spending was up 24% year over year. Some of that is a little bit to do with the base effect of comparing to that economy that was really only operating at 38% capacity in April of last year. But that's a tremendous amount of spending growth that we've seen. So we went from the hope that the economy would start to recover. Now we're actually seeing that come to fruition. The housing market continues to be incredibly hot, spurred by those low interest rates. Really, the number was flat month over month for the most recent reading. We think that is really just a temporary pause, as some builders have paused in terms of new construction just because of the supply constraints have increased the costs of many of the materials that go into homes. We expect the housing market to continue to be very, very strong. And we've continued to see initial jobless claims decline about 385,000 as of the most recent reading. That was well into the millions during the depths of the crisis. So we're seeing that labor market recovery occur as well. And taking a look at some more high frequency data, this gives us the best insight into how the economy is currently operating. So we've like to look at the minimum, where kind of they fell to based on the pre-COVID baseline during the depths of the crisis, and then where we're at currently. So mortgage applications fell pretty sharply, and they're now up 16% above that pre-COVID baseline. Consumer debit and credit transactions, we get that real-time data when customers are swiping that card, is up 20% from the pre-COVID baseline. Hotel occupancy, a lot of the travel data is really where we saw complete shutdown, where there was no activity in that segment. We're starting to see recovery in that as well. Really, the two areas where we have a little bit more work to do are in hotel occupancy and TSA traveler traffic. But after the Memorial Day holiday, we saw a nice boost in that. And we think as we continue to distribute the vaccine, we're going to get back to that pre-COVID baseline sometime later this year. So the risks that come with that, I talked about how we were going to talk about some of the negatives that may come from all that fiscal policy support, is potential inflationary pressure. So we were expecting the most recent readings that came in pretty hot from an inflation standpoint. Again, a lot of that has to do with a base effect from comparing the year-over-year number to April of last year, when, again, the economy was only operating at 38% capacity. We also have seen some supply issues. The Suez Canal being blocked for several days was one contributor to that. We've also seen some manufacturing disruptions due to COVID, some intermittent shutdowns. So those supply constraints, we believe, are going to be relatively short-term in nature. And this inflationary pressure was well expected by economists, and we think really by September to November time period, we should have some insight into whether that is going to be more permanent or transitory, which is currently the Fed's view. The Fed is expecting that this hotter inflation is going to start to slow down as all of those elements come together in the back half of the year. But it's a really important question, because we think inflation is really going to dictate where we go from here. So I want to lay out what our base case is and then talk about the potential risks. So we think there's an 80 to 85% chance that the next part of the economic cycle, next part of the business cycle, is going to play out very similarly to the previous 4 expansions that we've had for the US economy going back to 1980. So those 4 were incredibly long periods of expansion where you really had a Goldilocks environment where the economy is not running too hot and it's not running too cold, and we're able to have a very long, relatively modest period of economic growth rather than really sharp growth, which is then leading into a shorter cycle where we see a recession much earlier. So our base case is that we will likely see that come to fruition. We might get to the mid-cycle environment a little bit more quickly than we typically do, just because of how accelerated this recovery has been. But if inflation is transitory, if the Fed's view is correct, then we will likely really return to the time period, if you want to think from an economic or market standpoint, to calendar year 2017 or calendar year 2019, where the economy is growing nicely, but it's not too hot. We're not seeing strong inflationary pressure, no excesses in the system. And then we can continue that economic growth environment really for a significant period of time. The other risk we see, however, is that there is a potential inflation overshoot that is much more permanent than the Fed is currently pricing in. So we would say this has about a 15 to 20% probability. We already are seeing this reflationary environment in place today. If that continues to accelerate, that's going to increase the risk of a policy error. So economists have said for a long time, the economic growth cycle does not die of old age. It is murdered by the Fed, and that is by the Fed raising interest rates to the point that it really inhibits economic activity and then causes a recession. So if inflation is more longer lasting, that increases the risk of the Fed tightening monetary policy either too soon or too quickly, which could then shorten the overall economic cycle. And then we would really want to look from that standpoint at how would that economic cycle end. So really it would end in one of two ways. The one I just spoke of is the rate shock. We think that is overwhelmingly the likely end game if we continue to see these hot inflation numbers come in and not really get back to that normal 2% baseline number that the Fed is targeting. And that is that rate shock. The Fed raises interest rates in the face of that inflation to try to slow down the economy. Typically, they're going to end up causing at least a moderate slowdown or recession in the economy. Sometimes that can be even more substantial. But really the growth shock, which is really, I would say, represented by something like COVID, where you have an exogenous shock to the system that makes economic participants really concerned about the future growth of the global economy. That is a very, very low probability. We would say that's probably a 1% probability if we see this reflationary environment continue to accelerate. That it's hard to predict where that might come from, just like it was very difficult for anyone to predict that COVID would be the reason for the 2020 recession. But geopolitics, I would think, is a prime area where that potential type of shock could come that would end the economic growth cycle and result in a recession. But I want to reiterate that is not our base case. We overwhelmingly think that we're going to see this Goldilocks scenario that I discussed, where the economy is growing neither too hot nor too cold, and it's going to be a much longer economic cycle than this shorter term cycle. So do we have any time periods in history that might give us some insight if we do see this reflationary period occur? Looking back, actually the period after World War II looks very, very similar. So in terms of the fiscal and monetary policy environment, we had very low interest rates. We had significant government spending to fight the war, and then that fiscal stimulus came out of the system, and we also had a very high savings rate. So what happened in the intermeeting years after World War II, as that fiscal stimulus was removed and interest rates rose? The cycles were shorter, but they also were much shallower. So the recessions that did occur were much less severe, and the equity market drawdowns or the risk asset market drawdowns were much less severe during that time period. So if we do see this reflationary environment continue to accelerate, that really offers us a potential guide to what it might look like. But again, our base case is that we again return to that Goldilocks environment and continue to have that stronger economic growth for a longer period of time. So what are we looking to tell us whether this inflation environment is going to be transitory or if it's going to be more permanent? What we look at is what's called the inflation break-even rate. So this is the difference between a regular US Treasury bond and then a US Treasury inflation protected security. So a Treasury inflation protected security compensates you by adjusting the bond for whatever the CPI number or whatever that inflation number is. And how we can interpret that difference is what market participants are expecting inflation to average over the time frame or the life of the bond. So we're looking here at a 2, a 5, a 10, and a 30-year break-even rate. And right now we're seeing the 2-year and the 5-year be above the 10 and the 30-year break-even rate. What that tells us is that market participants are expecting the hotter inflation to be shorter term in nature. And particularly we've seen in the last several weeks, the 5-year break-even inflation number come down. That suggests that the expectation is inflation is going to be very front-loaded, meaning the market is buying what the Fed is selling, and this inflationary environment is going to be transitory, not more permanent. But we're going to continue to monitor that because that's going to be the key. Again, we think that inflation question is going to dictate where we go from here. So just turn very quickly before we open it up to questions to the markets. From an asset standpoint, we've had one of the greatest runs we've ever had for risky assets over the course of the last year. Just a phenomenal recovery in all areas of the stock market. Really, the only area where returns have been relatively muted have been in fixed income. And again, that's because we've got that incredibly low interest rate environment. So we continue to think, given the economic growth environment, that stocks are relatively attractive to what you can earn in the fixed income market, and show a couple reasons for that. First is taking a look at equity returns during economic expansions. So this tells us what the probability is of achieving particular returns. So we've got an 87% probability of a 1-year forward return when the economy is expanding of 87%, and even a 30% probability of having a 20% or greater return during that 1-year time period. We're not even to the expansion yet. We're currently still in the recovery stage. Once we get past that pre-COVID trend line, that will signify that we're finally in that expansionary phase. So we've got a very high probability of continuing to see strong equity market returns, and a relatively low probability of having negative returns in the stock market. And in terms of the trough to the recession returns, the median has been about 138% since World War II. The average is skewed by some really, really strong numbers. So that's 195 in the last 4. Between when we have the trough and the next recession have been a 400% return in the stock market. So right now we're still just at about 88, 90%. So history tells us we still have a lot of room to run there. And one final point, I get this question a lot. The market is continuing to make all-time highs. Is this really a great time to be investing in the market? This takes a look going back to 1988 of investing on just any random day in the stock market versus putting new money to work at a day where the market makes an all-time high. The returns are actually greater when you invest at a new all-time high, because markets tend to exhibit momentum. Most all-time highs tend to cluster together because the stock market is continuing to rally and continuing to be strong. So contrary maybe to what intuition might tell you, when the market's at an all-time high, it's actually, history tells us, a very good time to be invested in the stock market, both from a short-term and a longer-term perspective. So I'll pause there and open it up to any questions. I think we've got a few moments left if there are any in the audience. And thank you for having us today. It was a real pleasure.
Yeah, Matt, I understand that with the Zoom presentation, audience participants will need to type in their questions and answers so that we can hear them. We have everyone muted on the listening end. So
and while we're waiting, I will throw out there. So I had to give a very abbreviated version of that presentation just for the sake of time. If you're interested, I publish a lot of work for us, particularly over the last year or so. Just recently published a piece really detailing our view on what I just discussed. And then we have another one that will be coming out next week. If you're interested in receiving those, please feel free to reach out. Let us know. We can add you to our distribution list. You can also find those at our website as well if you're interested in the more detailed version of our outlook.
Yeah, and Matt, audience participants can reach Christina for our contact information, or real quick, I am J Bankert, Bankert, at fultonbank.com. And Matt, you are M Brennan, Brennan, at fultonbank.com.
Correct.
All right, well, it doesn't look like we have any questions coming in, but certainly you may email us or you can give us a call if you have any further questions regarding these topics. Very interesting today. Thank you so much for sharing. And here at Homestead, we do have some additional upcoming events. So if you check our website in our events tab. We would love to have you join us. And we hope that our next event will be both in person and digital, virtual. So we'll have a socially distanced audience here at the Bachman Center for our next presentation, which will be June 24th, I believe, Dave Burkholder regarding downsizing and making a move. So we hope you have a wonderful weekend. Thank you for joining us, and we hope to see you next time. Thank you.